Welcome to this FX and Commodity Rundown. As you can see, it's not Alex Haywood, it's actually Brannigan filling in for Alex today. Our objectives, very briefly, we're going to talk very briefly about the Fed, do a little bit of sort of a scenario analysis and what the outcome will be for the dollar and the commodities this week. We're then going to talk about the euro, the Aussie, the pound, before looking a little bit at the copper and the emerging markets. So to start off with, very briefly, I just want to quickly run through the calendar. I think it's quite a key calendar for this week. That's why I've included it into the FX and commodity stream. Take note, we've got a lot of CPI data this week. We've got the UK, the US, and Europe and Canada all reporting inflationary data this week. It is probably the single most important driver at the moment of currencies, simply because of this, the diverging interest rate stances. What I would say is, obviously, it's expected for Canada and Europe inflation and the UK's inflation to be low, if not lower or negative, whereas the US is kind of any kind of an uptick in inflation, which is expected for the year-on-year core, and we could get some very, very aggressive positioning in the dollar heading into Thursday's FOMC meeting. So just wanted to point that out. We have then got obviously retail sales from both the US and the UK. Again, very much market-moving data for the currencies. And then just one last highlight. This week is all about FOMC. It's FOMC week, probably the biggest FOMC we've had for 6, 7, 8 years. There's a lot going into that, so we will briefly talk about that. So on that topic, let's just quickly, I just wanted to kind of almost talk about this FOMC and just talk about two of the likely outcomes we could get. Now, the first one we want to talk about today is effectively the idea of if we get a hike. So if we get some sort of a hike come Thursday, okay, the implications for the dollar are as such. We should see a strengthening dollar. Okay, we should see a very aggressive move into the dollar in the near term. Now, how long or if that is sustained is very much dependent on how the market perceives, Yellen's stance going forward. In other words, if she comes out and openly says, we're likely to hike now and start a gradual path of hiking over the next couple of months, the market could take that somewhat more hawkish than what's expected. So over the long run, we should start to see should see a continuation of the dollar trend. However, if she were to come out and hike this week, Thursday, but almost dampen expectations of future hikes, almost saying to the market, this is a one-off, it's so that, we kick things off, but don't expect anything more this year, or, and maybe we start again early next year, all right, that kind of a sort of a hawkish hike, yet a dovish stance, could actually, in effect, see the dollar initially rally quite aggressively before actually turning back around as the market almost starts to reprice the curve going forward. So that's the first type scenario. The second type scenario is a scenario where, and this is probably more expected, is where the Fed doesn't hike on Thursday, but they lay the groundwork for an October hike. Now, that can come in a number of forms, and we will discuss that down the path. But the important thing to understand is in that case, we could again see some sort of a knee-jerk type response, where initially we see a flush out of any long dollar positions, and then the market sort of says, well, we're going to hike in October anyways, which is quite bullish for the dollar. Let's buy those dollars back up. So again, some sort of a knee-jerk type response. So those are the two main scenarios heading into Thursday. So if you're a dollar trader, make sure you understand those scenarios and any other potential scenarios. Now, from a commodity perspective, well, it's very much simply the inverse. In other words, if something hawkish comes out, like a hike, all right, that should make the dollar rally, which should send the commodities under a little bit of pressure, downside pressure. So, and obviously vice versa. So that's the Fed effectively. Just very briefly, let's touch on that chart again. Two things I want to point out. We are in a triangular formation. We are very much in an uptrend. Don't forget, we're still very bullish. Note, of course, the compactness. That's 2 weeks in a row now where the market's very compact, very much inside itself. But don't forget that very strong buy-side tail. So right now, what I would say is if you're a dollar trader, I would expect to see, particularly now with a failed break of this week's low, I'd expect to see some dollar strength heading into Thursday. How much strength? Well, I find it very unlikely the dollar's going to manage to get much above 96.5 before Thursday. I would think we should see further consolidation this week heading into the Thursday. So that would be the dollar from a technical perspective. Now, let's turn our attention to probably the main market of the morning, which has been the euro. Two things I want to point out on the weekly chart. Okay, we've been talking about this trend line that's sort of, it got snapped. It's a weekly trend line to point out first. It got snapped through, 2.5 weeks ago on Black Monday when we had the very, very short, big squeeze against anyone who was long dollars. And last week it kind of formed a bit of an inside type week, and very early on this morning we had comments out of ECB's Kure, who came out and effectively, Bonici, and he came out and said that the market has misinterpreted Draghi, and that it's very unlikely they're going to do QE in the near term, and it's way too soon to even be talking about further asset purchases. And obviously the euro caught a little bit of a bid on that, it sort of went up 20-25 pips. And then all of a sudden, someone stepped into the market and started very, very aggressively selling the euro. And not just selling euro against dollar, he sold euro against cable, yen, all the major currency pairs. So someone stepped in this morning to sell the euro. Now, what I do want to point out is, I'm just going to zoom in on this action and make this a 5-minute chart so I can show you guys how a technical pattern, which was that weekly trend line, looks on a shorter term time frame, like a 5-minute chart. Now, there's the signal candle we're talking about. That big green candle is obviously the Bonici candle. Now, as you can see, effectively, once it hit this price point, not only did the sellers sell it back down, once the market had consolidated and the buyers stopped buying it, he then took it again, and he then took it again. It then bounced, and he's then taken it again. It's then bounced, and he's taken it again. So someone stepped in this morning very, very aggressively, looking to sell the euro, not just against the dollar, but against some of the other currency pairs. So for me, what I'd be looking for, that is for me quite an important high for the week. I would say it's very unlikely we're going to get back there today. And if we did get back there today, I would expect that to remain resistance all week. So keep that price point in mind. It's a trigger point. Someone institutional stepped in there to do some business. And obviously, I would be favoring, if I was to zoom this back in, given now that we've held that trend line on the weekly, I would be looking to target back down towards at least, again, expectations. We're unlikely to see anything major ahead of Thursday, but I would like to target this euro back down towards that 112 area heading into Thursday. So that's the euro dollar. Let's then turn our attention to something that's quite important, and I've showed this in a number of charts before, but or in fact I showed it a few weeks ago, and it's looking quite tidy. What we've got here effectively is, at the top we've got the euro sterling, and at the bottom we've got the DAX. Now, the reason I pointed this out was because I showed you guys back a few weeks ago how the euro sterling was almost acting as a very good risk on barometer, risk on, risk off. In other words, when euro sterling started to rally, effectively we would see the DAX sell off, as in this case. So as the euro sterling rallied, because euro is now considered a carry currency or a risk off currency, safe haven bet. Effectively, what we see is very aggressive sell side action in the DAX, and I kind of said to you guys, it's so important that it's not these little increments that we're after. We're not worried too much about these little increments. What we're worried about is when the market does in a very aggressive move like that. So what I kind of leaned on was that pay attention to this market from a technical perspective, because if all of a sudden the euro pound starts to rally again, that could give the DAX or any other European equities the volatility toward the downside. So the reason I'm showing this chart is because quite nicely, you can see the structure looks very similar in both instances. Now, I know we're all kind of waiting for a catalyst to see these European equities maybe have another little push lower, or at least another little directional move to the downside, and maybe, just maybe, if we can get above the 74 cents in the euro sterling, that might just be some form of a catalyst. However, as we can see, we failed again at the 73.50 today, so keep an eye as a first resistance on how 73.50 behaves in the euro sterling. But again, guys, make sure you use these little correlation opportunities to make to add to your trading. So that's the euro sterling I wanted to talk about. Let's then push on. I'm just very briefly going to touch on the Aussie dollar. I did speak quite extensively about the Aussie, but as we can see now, very early on this morning, we've taken out last week's high. The Aussie's come in nice and aggressive this morning. It's been well bid up, probably the best performer against the dollar today. So again, it's this continued theme of, our central bank has told us, our RBA central bank Stevens has told us 72 cents is fair value. We've seen China bounce. We've seen commodity markets bounce. As a result, we're starting to see the Aussie dollar just find a little bit of a bounce. Note, guys, this is not necessarily a turn in trend, but a little bit of reprieve after the recent aggressive sell-off we've seen both in China and obviously Australia being their main trading partner. So that's the Aussie. Not too much to talk about in terms of upside. Well, I would definitely not be looking, to be selling this market too aggressively now. Don't forget, guys, if I was to get any RSI or momentum indicators, you'll very clearly see we are very much oversold in the Aussie dollar. or in most of the commodity type currency space. So I'd be looking, if anything, for just a continuation bounce back up towards that 72 cents, at which point maybe somewhere there, given this, these recent tails we had before we broke lower, maybe somewhere there I might look for a short. But again, guys, these bounces can, they're very difficult to judge in terms of where they stop, because as a trader we don't know how much profit taking will occur, and that's the difficulty. So for right now, looking for continued upside back up towards 72 cents. So that's the Aussie. Let's turn our attention now to something actually that I haven't spoken too much about, and that for me is the copper market. So copper has been a particularly interesting market. It's been a very good gauge in the past of economic activity and economic growth. Now, the reason I want to talk about copper specifically today is because of the big fat word China. Now, I'm going to talk extensively about China when we head into the FOMC, and the reason I particularly want to pay attention to this today is all we're reading about, if you go through any kind of a financial newspaper today, all you're going to read about is the slowdown in China and a hard landing in China and the end of the world because of China, and the Fed's not going to hike because of China, and China, China, China. Now, two things I want to point out is that, yes, China is slowing down, but again, China's been slowing down for a number of years. China's not a new story in 2015. It's actually been, a new story since, or an old story since 2012, 2013. What I do want to point out, obviously, is copper's very, very aggressive down move. We saw a very, very almost panic type sell-off in conjunction with, the China sell-off and the Shanghai sell-off. Now, what I want to point out is how strongly correlated, the Shanghai has become, and the Shanghai index, as well as the China story, has become with copper as a commodity, and more importantly, what we can utilize this information for going forward. So what I'm saying in essence is we pointed out now that fundamentally everyone's very nervous about China and the slowdown, the hard landing, yet from a pricing perspective, that it's not that we are very much in oversold conditions, but we're almost seeing a situation where the market's become a little bit too negative or a little bit too dovish on the China story. And what I wanted to point out particularly was how we kind of had that engulfing week. We then had sort of a consolidation week, and last week we had a very, very strong full-bodied candle, all whilst this whole China story has been going on and gaining traction. Now, another reason why I particularly want to mention China is because the Fed has told us a number of times, not the Fed, we've heard from the ECB and the Bank of England board members a number of times that China is too early to talk about it. The impact of China on the rest of the world is too early to talk about, and there's no point in, for instance, in the ECB's case doing more QE yet, or in the Bank of England's case of panicking because and most likely in the Fed's case, there's no point in them, making anything huge of China just yet. So what I want to point out is, from a technical perspective, China is not quite, or at least copper's not quite seeing, it's seen the fearful down move, and it's actually consolidating and bouncing quite handsomely now. Again, we are above that 243 key level. In terms of the upside, again, it's a consolidation bounce. So where we get to is anybody's guess. What I would say is, obviously, somewhere around this week, we had very aggressive sell-side action. So I wouldn't be surprised if somewhere in here, we saw some sort of a resistance or some sort of a defense of higher levels. Other than that, guys, keep an eye on copper. Keep an eye on it as a barometer for just global risk appetite. If this copper suddenly starts to aggressively move up, okay, that could give not just the Asian equities, not just the emerging market equities, but all the equity markets a little bit of a bid. So that's the copper story. Let's turn our attention now to probably the highlight of this week. That's the emerging markets. Now, two things I want to point out and just talk about. The first thing is this chart, which is the MSCI Emerging Market Equity Index. Now, again, guys, what I want to point out with the emerging markets, and please listen carefully, all we've heard about emerging markets is how if the Fed hikes, the emerging markets are going to collapse and the end of the world because everyone's pulling money out of the emerging markets. Now, two things I want to point out. Back in 2013, Ben Bernanke created the taper tantrum. It was the first time he made mention of the end of quantitative easing, and we had a very, very aggressive sell-off in emerging market equities. Now, the second time when we ended tapering last year, or the preempt, or when we started tapering, which is that point there, again we saw a very aggressive sell-off in equities in emerging markets. And again, for the third time since the beginning of the China story, okay, we've seen over the last couple of months another very aggressive sell-off in emerging market equities. Now, The reason I point this out is because people make the mistake. They tend to assume that emerging markets will sell off as a result of the Fed hiking. Now, that's a little bit inaccurate because, in essence, the market has already sold off, preempting a potential rate hike cycle. So I just wanted to point that out, guys. We're already 6 months into the sell-off now. You know, we have seen, or maybe not even 6 months, but we could be 2 years into the emerging market sell-off already. And, you know, market participants are only starting to now flag emerging markets. So just remember that, because we could see actually something very different from what the newspapers are spinning us at the moment in terms of the emerging markets going forward. And on that note, I just want to have one quick little look at the emerging market space, and then we can finish off there. So just very briefly, as we've done in the past, we're just going to look at our grids again. As we can see, early on this week, Turkish lira is being hit, as well as the Brazilian real. Those are the two currencies that are weakest at the start of this week. And then the strongest are, again, our Indian rupee, our Mexican peso, and our South African rand. So right now, you know, what we're seeing in emerging markets is continued weakness in Turkey and Brazil as a result of political instability, etc., etc. But we're actually starting to see a continued stability from the other emerging markets. Now, remember what I said, guys. Don't forget, the emerging market story is almost 2 years old. It's not just beginning to start now. Now, it's not to say emerging markets can't sell off more. What I am saying is, don't expect, you know, when, for instance, you know, South African rand is already 45% depreciation over the last 2 years. Don't expect it to depreciate another 30-40% just because the newspapers are spinning this very, very aggressive story. So let's leave it there. Let's wrap up. If you have any questions, guys, about anything I've spoken about, please feel free to send me a message on Twitter. Otherwise, good luck this afternoon. Good luck for the week in the FX and commodity space, and we'll catch up again on Friday.